Let's talk about a very important investment decision you need to make. This does not involve which securities to own, but rather how to own them. Hi, I'm Phil with a Henry Wealth moment entitled Mutual Funds versus ETFs. Let's consider three main ways to construct a portfolio. The first is to own individual securities. The second is to own a pool of securities within a mutual fund, while the third is to own a pool of securities through an exchange-traded fund, also known as an ETF. For most of us, owning individual securities can be expensive and cumbersome, especially if you want a portfolio that's truly diversified. For example, if you wanted to build a portfolio of individual stocks to replicate the S&P 500, that's an index comprised of the 500 largest public companies in America, well, you would need to acquire and maintain 500 stocks. That's a lot to keep track of. This is why most investors who want to own a large pool of securities have historically done so within a mutual fund. Yet over the past decade, exchange-traded funds have exploded in popularity. I like to refer to ETFs as mutual funds 2.0. Let's consider some key differences. While mutual funds are purchased directly from a fund company, ETFs are traded on an exchange, just like an individual stock for that matter. And with a mutual fund, if you want to buy or sell, you get the price per share at the end of a given business day. With an ETF, however, you get the price right at that moment during the trading day. And here are two more big reasons that favor ETFs from my perspective. First, for non-qualified or taxable accounts, mutual funds can and do distribute capital gains in some years, even if you did not sell any of your shares. That rarely happens with an exchange-traded fund. Gains or losses usually only occur with an ETF if and when you sell. And finally, we need to talk about the F word, fees. The expense ratio within ETFs in most cases is much lower as compared with mutual funds that hold similar securities. So for our clients over the years, we've built well-diversified portfolios, typically using mutual funds and oftentimes utilizing portfolios offered through Symmetry partners. Yet recently, we've been using Symmetry ETF portfolios that are now available for new accounts, and we're also circling back to existing clients to reposition accounts to ETFs when it makes sense. And this is a conversation that we're having at regularly scheduled review meetings. I hope this short summary about the differences between mutual funds and ETFs has been helpful. At Henry Wealth Management, our mantra is this: the first thing we earn is trust. For more information or to schedule a meeting or a call with us, please visit our website, henrywealth.com. Thank you.